Welcome, everybody. So today's topic is a follow-on from last week's, which is that we are discussing how to choose which stocks and shrink your investment universe to something more manageable than 100,000 stocks. So today, one of the things we're going to discuss is what is called shameless cloning. And that's a phrase that Manesh Prabrai, one of the world's great investors, uses when he describes this method. And what it is essentially is you look at what other great investors have chosen to do with their money, and then we do our own research, we make our own decisions, but by putting it through the filter of other great minds, we shrink down the investment universe from 100,000 stocks to maybe 100 or 500 stocks to look at. Depending how many famous investors we look at and which ones. And we obviously choose investors that we believe are doing good investing, good value investing, because that's the only kind of investing we believe in. And I'll put it over to Eugene to describe a little bit more about how we do this.
Yeah, hi guys. And the point which Nick started is really great because in this case, you can just improve your circle of competence tremendously, and you can really decrease some risks connected to the investment if you just starting out. There is no so much new things under the sun nowadays. So probably someone has already done which you would like to do in investing and finance and different business topics. And you can just go to the Google and find those people who already are managing billions of dollars in their funds, and they are private or public investors. And you can go to different websites like Dataroma, Guru Focus, SumZero, Value Investors Club, and others. And you need to just understand who are these people. And you need to understand that this particular person has their similar or the circle of competence which you would also like to obtain. You just go through the list of his or her public portfolio, because as you probably know, if the person is in the US, he's obligated to fulfill and to write down a particular report, which is called 13F, write down all his positions, which he already has in his public or private ownership. So you just go to these reports and you can look through all of them, and you start to understand why he or she chose them. And you just start learning so much about the company from this perspective. And this can be one of the filters, as Nick says, because these guys already done the work and they have already spent a lot of time analyzing, maybe talking to management, traveling to the company's headquarters. This can be your advantage into stock analysis. So what do you think about that?
Absolutely right. Things to consider, though, is one, the data will be a little old. They're only required to report once per quarter. So potentially they bought 3 months before. But that shouldn't stop you from using this method. A big study by a major university determined that if you bought the same stocks as Warren Buffett at the highest possible price, and you did that for 10, 20 years, your returns would be amazing. And that's just blindly copying what he does without thinking about it, without checking that you're getting it at the same price as him or lower. Often you can buy companies at a lower price than these super investors. In fact, there's examples all the time. You look at a good investor like Manesh Prabrai, you look at what he's invested in, and you go, hey, the price is lower right now than what the super investor bought. Let me buy some of that. The only downside I can think of is that super investors manage so much money that they don't buy small companies. And so you're only really looking at the big companies, and often the growth won't be as good as the small companies. But there's a lot of safety in buying a large company that's got the stamp of approval of a super investor. And so this method is quite exciting. It's quite interesting. Identifying the super investors that you want to copy, there's an easy trick, I believe, that I recommend for people. When you go to a site like Guru Focus or Whale Watchers or whichever one you use, Dataroma, You get to see all of these different managers of funds, and you get to see how much money they're managing. The ones that have a portfolio of a small amount of stocks, where they've got the majority of their money in a small amount of stocks, even if they've got 100 stocks, but like 80% of their money is in 5, 10, 20 stocks, that's probably the kind of investor that you want to follow. If they've got thousands of stocks and it's not concentrated in like 20 stocks, they're not the right kind of investor. They're managing a lot of money in a way that's not going to really get great returns. They're more interested in sort of following the market and managing as much money as possible. What you want is someone who's so confident in the research that they've done that they've concentrated their money in just 20 stocks. And the other ones could be what's called tasters, where they're just getting a taste of the stock. They're kind of interested in it, but they're not committed to it. So you want someone with a heavy commitment, and you can look at all the different investors that have done that, and there's quite a good amount of them. I'd say there's probably at least 100 guys who are publicly showing their portfolio. Obviously, there's a million ways to invest, so each of them will be different to each other in what they look for and how they determine. But these are typically successful guys, and so by cloning them, that's one method of shrinking down. We're going to discuss another method shortly, but first we're going to close up this topic.
This is the end of this episode, guys. We will continue next time. And if you have any questions, please write them down in the comments below. And see you next episode.